So the fund looks to invest in infrastructure assets. It's global in nature, so we're looking at opportunities all around the world. It's a total return that we're seeking, so a combination of a, say, 3 to 4% yield, 5 to 6% growth in income or cash flows to deliver an 8 to 10% total return through a full cycle. The nature of infrastructure means that we'll probably be a little bit more defensive in down markets, but deliver a good solid return through the cycle. So the investment process is very much bottom-up stock driven. We're probably 80% bottom-up with a 20% top-down overlay, thinking about some of the macro risks. We do a lot of on-the-ground research to build our ideas. We look for mispricing in stocks, so certainly looking for value within the portfolio, and a real strong quality assessment, making sure that our companies have strong barriers to entry, very predictable cash flows, run sensibly by a good management team, and a real focus integrated in the process on environmental, social and governance factors to make sure that we invest responsibly over the long term. Differentiators, I think our on-the-ground research is key. We do over 500 company visits per year, not just meeting with management, but getting down to the assets. The asset tours really help us understand the culture of a business. We meet with regulators, meet with competitors, spend a lot of time thinking about what can go wrong with a business as much as what we expect to go right. So the long-term performance of the fund has been very good, very positive. The one-year performance has been exceptional. The falling bond yield environment, uncertainty in markets is certainly helpful for a defensive income-generating sector like infrastructure. And as active managers, we've been able to add significant alpha on top of that. So a good period for the fund. Yeah, so a difficult period for infrastructure investors is a risk-on market. Sharply rising markets, momentum-driven markets. Infrastructure may get left behind in that type of environment. Conversely, where infrastructure does particularly well is a more challenging period where there's uncertainty, where people are thinking more defensively, when bond yields are perhaps falling. That's when infrastructure will come into its own and deliver a less correlated return to broader markets. Yeah, I think the long-term structural drivers are an important factor to consider for returns. Think about the decarbonisation of the electricity grid. As we replace fossil fuels with renewables, we'll need a lot of infrastructure to support that growth long term. Mobility of data. Think about how you consume on a mobile phone, watching videos, downloading content. The wireless infrastructure that supports that is an important growth driver. Moving energy around the world. There's an excess supply of energy in North America. Setting up the pipelines, the LNG terminals to export that energy around the world is an important opportunity for infrastructure investors.